If you look across Europe, there's just this immense pool of wealth, right? Billions, maybe trillions in private savings, often just sitting there, not doing much. And the really big question for Europe now, the multi-billion-dollar question is, how do you build a kind of bridge, a secure way to get that money into the big long-term stuff we need? Think new data centers, fiber networks, all that infrastructure for the energy shift. So that's the heart of our deep dive today. We're looking at the huge reform of the European Long-Term Investment Fund, or ELTIF. It's been relaunched as ELTIF 2.0. This new setup, it kicked off January 10th, 2024 Regulation EU 2023-606. If you're taking notes, and honestly, it might be the most important bit of financial rulemaking this decade for unlocking Europe's future financing.
Yeah, and it's really crucial to see this the right way. The LTIF thing, it's not a bunch of different country rules. It's one single regulation for the whole of Europe. Applies the same everywhere, EU, EEA states. And its job, well, its main job, is to get that patient capital, that long-term money, into the EU's real economy, specifically funding those long-view projects that usually aren't covered by just buying stocks.
And the need for change was, well, pretty obvious. The first version, ELTIF 1.0, it was basically a non-starter. I think the figures show fewer than 100 funds registered by 2022. It was just too rigid. So our mission today is kind of twofold. First, let's figure out exactly what regulatory changes suddenly made this thing work, made it attractive. And second, why is one place, Luxembourg, really emerging as the go-to hub for setting up nearly all these new ELTIF 2.0 funds?
That low uptake, it was a major headache for the European Commission. Definitely showed the first version was, well, broken. Revising it wasn't just about flexibility, though. It was about staying competitive. They needed a smoother path for long-term finance into infrastructure, into SMEs, small to medium enterprises, but also, critically, giving fund managers the actual tools to make these investments worthwhile. And if you zoom out a bit, ELTIF 2.0 is really Europe's answer, a targeted regulatory move against the, frankly, overwhelming growth of the U.S. private markets. It's about financial independence, sovereignty. A big political goal is democratizing access, letting ordinary European savers into these potentially higher return private assets, while also directly supporting the EU's big plans, like the Capital Markets Union and the Green Deal. It's about keeping European money working in Europe.
Right. And the thing holding it all together, regulatory magic, is the EU passport. So if you're a fund manager based in the EU and you're authorized under AIFMD, that's the standard rulebook for professional funds, Alternative Investment Fund Managers Directive, you automatically get the right to manage and sell an ELTIF product across all EU countries. Simple, cheaper, cross-border sales. No need for, 27 different national rubber stamps?
Exactly. A huge efficiency gain.
Okay, so let's get into the details then, because the changes in this regulation 2023-606 really were, well, a massive upgrade, a great modernization, as you might say. The theme seems to be the shackles are off.
That's a perfect way to put it. ELTIF 1.0 really choked on its own restrictions. The changes in 2.0 just massively broaden what these funds can actually invest in. So, for instance, private credit lending directly to companies that's now clearly in. Real assets, super important for infrastructure, now covers things like logistics parks, social housing projects, even listed SMEs, small companies, as long as they're under 1.5 billion market cap. But maybe the biggest game changer for the managers, funds of funds are now allowed. Before, you had to pick every single direct investment. Super restrictive. Now managers can spread risk, use specialist managers through these funds of funds, as long as they do their homework, the due diligence. It makes the whole thing much more sophisticated, much more scalable.
And on the money side, the borrowing limits, they got loosened up quite a bit too, right?
Precisely. If the fund is only being sold to professional investors, the borrowing capacity was boosted massively. You can now leverage up to 100% of the net asset value, the NAV. That's a huge dose of flexibility. Plus, those mandatory diversification rules, they used to be incredibly complicated and tight. Now they're more proportional, much more flexible, much closer to how things actually work in the industry.
Okay, now let's talk about the everyday saver, the retail investor, because this seems like the headline grabber. That minimum investment, €10,000, which kept most people out, it's gone, completely removed. And that, plus getting rid of that other rule, the one limiting ELTIF investment to 10% of someone's portfolio, suddenly you've got a real path for ordinary Europeans to get into private markets.
It's a massive shift in accessibility.
But hold on a sec, let's pause here, because this sounds great, but you've just taken away two big safety nets, right? No minimum buy-in, no portfolio limit. And these funds, they're investing in things that are hard to sell quickly. Solar farms, long-term private loans. Aren't we potentially setting up average savers for a shock down the road if they need their money back fast and the fund can't sell the assets? That liquidity mismatch risk seems, well, significant.
That is the core trade-off, absolutely. You've nailed the central tension in ELTIF 2.0. The regulators, well, they clearly decided the benefit of letting more people in outweighed that risk, provided the intermediaries, the banks, the advisors selling these things do their job with suitability tests. So while the minimums are gone, that suitability check, still mandatory. And the fund absolutely has to publish a clear key information document, a KID. It has to spell out the lack of easy liquidity, the long-term nature. The idea isn't to trick savers, it's to allow access with informed consent. That's the key difference from 1.0, which just put up walls.
Okay, informed consent. That makes sense.
Yeah.
So looking ahead, maybe into 2025, where's the money actually flowing with this new flexibility?
We're already seeing definite trends. Strategies are focusing on sectors with that combination of long duration and, ideally, stable, predictable income. Energy transition infrastructure is huge. Solar, wind, battery storage, all needing massive capital for the Green Deal. Digital infrastructure is just as hot. Data centers, fiber networks, telecom assets. Private credit is another big one, providing that senior or mezzanine finance, sort of middle-risk loans, to medium-sized companies that maybe can't get traditional bank loans so easily anymore. And finally, residential development is in the mix too. Things like building denser housing in cities, affordable housing projects, all now clearly investable through an ELTIF.
So just to lock down the access rules then, professional investors, pretty simple full access under AFMD, no extra LTIF hoops to jump through.
Okay.
But for retail investors, now the big barriers are down. The responsibility really falls on the advisor, the bank, to make sure it's a suitable investment for that specific person.
Exactly that. The product itself isn't instantly liquid, but the way it's sold relies on strict consumer protection. And the beauty of this structure is its reach across Europe for putting the money to work. I mean, think about it. You can have one single LTIF set up and based in Luxembourg, and it could be funding, say, the purchase of logistics warehouses near Madrid,
Okay.
while also taking shares in Spanish SMEs focused on sustainability and financing big solar farms down in Andalusia. The capital goes out granularly, all across Europe, but managed efficiently from that central vehicle.
Right, here's where it gets really interesting, the structural bit. We've established this is an EU-wide rule meant to deploy capital everywhere in Europe. But, like you said, everyone seems to agree Luxembourg is the place to actually structure the fund.
Yeah.
Why this small country winning out over, say, Germany or France or even Spain or Italy, where the investments might be going?
It really boils down to three main things: speed, the local ecosystem, and crucially, tax neutrality. On speed, Luxembourg's regulator, the CSSF, they've been dealing with cross-border funds for decades. They know this stuff inside out. That experience means predictable timelines for setting up a fund. You're generally looking at 3 to 6 months. For big fund promoters launching multi-million euro products, that predictability is gold. Time is money, right time.
3 to 6 months is pretty quick for regulated funds.
Okay. Then there's the ecosystem. You've got over 350 specialist fund administrators and depositories right there in Luxembourg, many with proven LTIF experience already. The whole support infrastructure is just there and ready to go.
But the big one you mentioned, tax neutrality.
That's the defining advantage, yes. Most of the regulated fund vehicles you'd use in Luxembourg, things like a RAIF, a SIF, a SICAFI, they are exempt from corporate income tax. They pay a tiny annual subscription tax, like 0.01% to 0.05% on assets. And here's the kicker. Generally, there's no withholding tax charge when the fund pays distributions out to investors who aren't Luxembourg residents.
Wow, okay. That sounds structurally very powerful. If we compare that, like the notes suggest, to Spain, a standard company pays 25% corporate tax, and then there's potentially a 19% withholding tax on dividends going abroad. Even with tax treaties, that's a big potential drag compared to zero at the fund level in Luxembourg.
Exactly. It creates significant structural efficiency.
But doesn't that create, I don't know, a bit of political friction? If Luxembourg acts as this central tax-neutral platform funneling investment into, say, Spain or Italy, those countries see the physical assets being built, but the fund itself isn't paying local corporate tax. Does that cause tension?
It's certainly a delicate point, which is why the term used is tax neutrality, not tax haven. The principle is that tax should be paid where the ultimate investor resides, not duplicated at the fund level. This structure facilitates cross-border investment without that double taxation, which is actually an EU goal. It optimizes the flow of capital. And that efficiency, as I said, is massively supported by just having all the expert services readily available, the administrators, lawyers, auditors, depositories, all specialized in exactly these kinds of complex, cross-border, often illiquid structures.
Okay, just to make this less abstract for listeners, myself included,
Here.
you mentioned acronyms like RAIF, SI, SCSP. Can you quickly break down what these are? Why does Luxembourg offer this choice?
Yeah, good question. Think of them like different types of legal boxes or wrappers you can put the ELTIF product into. The choice depends mostly on who the target investors are and how fast you want to launch.
Yep.
So a SIF, that's a specialized investment fund, or a SICA, those are sort of the classic, fully regulated fund structures supervised directly by the CSSF.
Okay, traditional.
Right. Then you have the RAIF, the Reserved Alternative Investment Fund. This one's the fast-track option. It's not directly supervised by the CSSF itself, but crucially, it must be managed by a fully authorized AIFM, who is regulated. That speed makes it super popular with promoters.
Ah, so oversight through the manager, not the fund itself. Got it.
Exactly. And finally, the SCSP, the Special Limited Partnership. This is basically Luxembourg's version of the limited partnership structure common in the UK or US fund managers, especially those dealing with sophisticated professional investors. Often love the SCSP because it offers much more contractual freedom and flexibility in how they set up terms while still operating within the ELTIF rules.
That really clarifies things. It's not just one option in Luxembourg, it's a whole menu of vehicles tailored for different needs. That flexibility itself is an advantage.
Precisely. And interestingly, even Luxembourg's own small local market kind of reinforces this picture of stability. There's steady demand for high-quality, real assets there, particularly green, ESG-compliant offices in areas like Kirchberg or Cloche d'Or. They offer stable yields. This local demand can give fund managers a solid base, maybe pilot investments, before they scale up their strategy across the whole of Europe using the ELTIF structure. The whole launch process now, from defining the strategy, picking your manager, choosing the legal vehicle, appointing oversight, submitting the CSSF application, planning distribution, it's become a much more predictable, mapped-out process.
So stepping back then, what's the big picture takeaway here? It feels like we're watching a fundamental shift in how Europe finances its future. This isn't just tweaking some rules, it feels like a real structural evolution.
I think it really is. ELTIF 2.0 has gone from being this, frankly, niche and failed regulation to a core strategic tool. It's becoming vital for boosting the EU's financial independence, its sovereignty, reducing reliance on outside capital, especially as we noted with traditional banks maybe tightening their belts on long-term lending. And Luxembourg, well, it's positioned itself perfectly, using its regulatory experience, that deep ecosystem and its tax framework, to be the engine room. It's the place that turns this high-level European policy into actual, investable, globally competitive financial products.
That's a fascinating transformation. Okay, so to quickly recap the key points for you listening, ELTIF 2.0 has completely overhauled the old system. It massively broadened the eligible assets, bringing in things like private credit, funds of funds. It's created a genuine pathway for retail investors by scrapping that 10,000 minimum entry ticket. And critically, it uses Luxembourg's efficient and predictable regulatory and tax system to enable that vital cross-border passport for deploying capital right across Europe.
Absolutely. And this convergence, bringing retail investors closer to these long-term, inherently illiquid assets, leaves us with a really interesting, maybe even critical question to ponder. The source material suggests ELTIFs are indeed stepping in where banks might be pulling back, particularly providing private debt for infrastructure. So what happens if this new class of semi-liquid products, designed partly for retail access, faces a wave of redemption requests? If ELTIFs become major lenders for essential long-term assets, what backup mechanisms might be needed to ensure the stability of that underlying financing if lots of everyday investors suddenly want their money back at the same time? That underlying liquidity risk, especially as this market grows, is definitely something to keep an eye on.